Welcome to the Certified GHG Accounting and Reporting Specialist course, where we delve into the science, urgency, and professional opportunities of greenhouse gas accounting. Developed by CDG Training, this program is committed to building the highest standards of sustainability expertise globally. The climate crisis is a pressing issue, with a 1.1 degrees Celsius temperature rise and CO2 concentrations at their highest in over 3 million years. The annual emissions are 57 gigatons, and the carbon budget is depleting rapidly, emphasizing the need for immediate action. Global GHG emissions have shown a historical upward trend, with significant contributions from various sectors. Achieving the 1.5 degrees Celsius target requires substantial emission reductions, highlighting the need for strategic planning and action. GHG accounting has transformed from an abstract concept to a business reality, driven by regulatory forces, investment focus, procurement processes, voluntary commitments, and physical climate risks. 5 key forces are driving the adoption of GHG accounting, including regulatory requirements and market-scale indicators, showcasing significant growth and scope in the field. GHG accounting professionals play a crucial role, requiring technical, analytical, and professional competencies to manage complex data and provide accurate GHG statements. The GHG accounting professional competency framework covers 6 domains, ensuring comprehensive expertise in climate science, accounting, inventory management, reporting, verification, and net zero target setting. The GHG accounting profession operates within a complex ecosystem of standards, guidelines, and frameworks, essential for professional growth and compliance. The GHG accounting standards ecosystem map illustrates the interconnected frameworks and standards that guide the profession, ensuring comprehensive compliance and reporting. From the Rio Earth Summit to the present, GHG accounting has evolved significantly, influenced by international agreements and standards, shaping the current landscape. GHG accounting presents challenges such as boundary setting, emission factor calculation, and scope determination, requiring expertise to navigate complex systems and ensure accurate reporting. The professional opportunity in GHG accounting is growing, with increasing demand for skilled professionals and significant market growth projected from 2020 to 2024. Career opportunities in GHG accounting are expanding, with roles ranging from graduate analysts to senior consultants, driven by regulatory demands and market needs. This course offers a comprehensive learning journey across 15 chapters, covering essential topics from climate science to regulatory challenges, preparing you for a successful career in GHG accounting. CDG Training emphasizes GHG accounting as a genuine management tool, focusing on insightful data collection and strategic decision-making to enhance organizational impact. The key takeaway is the importance of measurement infrastructure in GHG accounting, which is crucial for compliance, risk assessment, and supply chain programs, driving the sustainability economy. Begin your journey with CDG Training to become a certified GHG accounting and reporting specialist, gaining scientific rigor, professional certification, career opportunities, and global relevance. Every number in a GHG inventory is grounded in a body of physical science developed, tested, and refined over more than 150 years of atmospheric research. This chapter builds the comprehensive scientific understanding every GHG accounting professional needs to practice with genuine competence, not merely mechanical calculation. The Earth's energy balance is the equilibrium between incoming solar radiation and energy radiated back into space. Greenhouse gases absorb and re-emit infrared radiation, warming the surface. Without these gases, the Earth would be much colder. The enhanced effect due to increased GHGs is a significant concern. The natural greenhouse effect adds 340 W per square meter of forcing, while the enhanced effect adds 3.84 W per square meter. This additional forcing is a key driver of observed warming and climate sensitivity, which ranges from 2.5 to 4 degrees Celsius. Understanding these dynamics is crucial for climate science. The 6 greenhouse gases regulated under the Kyoto Protocol have distinct properties and atmospheric lifetimes. Carbon dioxide, methane, and nitrous oxide are the most significant, with varying contributions to climate change and atmospheric persistence. This slide provides reference data on greenhouse gas properties, including their global warming potential and atmospheric lifetimes. Understanding these characteristics is essential for accurate GHG accounting and climate modeling. Global warming potential, GWP, is a critical metric in GHG accounting, allowing for the comparison of different gases based on their warming effects. The choice of GWP values can significantly impact reported emissions and climate strategies. Comparing GWP values across different reports highlights the importance of consistent application in GHG accounting. Variations can lead to significant differences in reported emissions, emphasizing the need for standardized practices. Radiative forcing quantifies the change in energy flux at the top of the troposphere due to GHG concentration changes. It is a key concept in understanding climate impact, with total forcing in 2019 measured at 2.72 W per square meter. The climate system's sensitivity is influenced by feedback mechanisms and tipping points. Understanding these elements is crucial for predicting climate change impacts and developing effective mitigation strategies. This slide illustrates the risk thresholds for various climate tipping elements, such as tropical coral reef die-off and Amazon rainforest dieback. Recognizing these risks is vital for urgent climate action and policy development. Accurate measurement of atmospheric greenhouse gas concentrations is essential for climate science and policy. Techniques like the Keeling curve and satellite observations provide critical data for understanding global climate dynamics. The Keeling curve is a vital record of atmospheric carbon dioxide levels, showing a steady increase over time. This data is crucial for understanding the acceleration of climate change and informing global carbon budgets. The carbon dioxide equivalent metric allows for the comparison of different greenhouse gases based on their warming potential. It is a fundamental concept in GHG accounting, though it has limitations that must be considered. A real-world example of GHG tracking demonstrates the importance of scientific accuracy in emissions estimation. This case highlights the need for ongoing evaluation and revision of accounting methodologies. CDG training emphasizes the importance of scientific literacy in GHG accounting. Understanding the underlying science is crucial for accurate emissions reporting and effective climate strategies. The physics of greenhouse gases is the foundation of climate science. Understanding molecular physics, atmospheric lifetimes, and global warming potentials is essential for effective GHG accounting and climate action. The GHG Protocol Corporate Standard, established in 2001 and updated in 2004, revolutionized corporate greenhouse gas emissions accounting. It became a globally recognized standard, now used by over 90% of Fortune 500 companies for GHG emissions reporting. The GHG protocol is built on 5 foundational accounting principles: relevance, completeness, consistency, transparency, and accuracy. These principles ensure the quality and integrity of GHG statements. These 5 principles form a professional application framework, guiding the practical implementation of GHG accounting. They ensure compliance and provide a basis for consistent and accurate reporting. The 3-scope framework divides emissions into direct, energy indirect, and value chain indirect categories. This innovative approach allows for comprehensive corporate carbon accounting. A visual representation of the 3-scope framework shows typical emission splits by sector, providing a clear understanding of how emissions are categorized and accounted for. Scope 1 emissions cover direct emissions from owned or controlled sources, including stationary and mobile combustion, process emissions, and fugitive emissions. Calculation methods and data requirements for Scope 1 emissions involve various tiers and factors, ensuring accuracy and consistency in reporting. Scope 2 emissions, representing energy indirect emissions, can be calculated using location-based or market-based approaches, each reflecting different procurement decisions. A comparison of location-based and market-based accounting for Scope 2 emissions highlights the impact of procurement choices on reported emissions. Scope 3 emissions, the most significant category, cover upstream and downstream activities. They represent 70–95% of total emissions and are crucial for comprehensive carbon accounting. An analysis of Scope 3 category materiality by industry sector shows the significance of different categories in total GHG emissions, emphasizing the need for tailored strategies. Beyond the corporate standard, the GHG protocol offers additional standards for product lifecycle, project accounting, and land sector guidance, extending its framework. The GHG protocol aligns with ISO 14064. Providing a structured framework for GHG management and ensuring quality assurance and compliance globally. Microsoft's commitment to becoming carbon negative by 2030 exemplifies the practical application of the GHG protocol, showcasing dual-scope reporting and transparency standards. CDG training emphasizes the importance of understanding the GHG protocol beyond technical compliance, focusing on professional excellence and genuine climate impact assessment. The GHG protocol is more than a reporting framework, it's an intellectual architecture for corporate climate responsibility, urging professionals to master its principles and apply them with integrity. Every GHG inventory begins with decisions that affect data collection and analysis. This boundary-setting decision is crucial for accurate GHG accounting. It involves understanding the organizational, operational, and consolidation boundaries to ensure a professional approach. The GHG protocol outlines 3 consolidation approaches: equity share, financial control, and operational control. Each method impacts how emissions are reported, reflecting different ownership structures and influences. Comparing consolidation approaches reveals their impact on reported emissions. Each method results in different emission totals, highlighting the importance of choosing the right approach for accurate reporting. Operational control is the most common approach due to its alignment with management responsibility. It allows organizations to implement emission reduction measures effectively. Setting organizational boundaries involves choosing a consolidation approach, applying tests, and addressing edge cases. This framework ensures comprehensive and accurate GHG reporting. Defining the operational boundary involves determining which entities are included in the inventory. This step is crucial for accurate Scope 1 and Scope 2 emissions reporting. A consumer goods manufacturer applies the GHG protocol's relevance framework to decide on Scope 3 category inclusion. This assessment ensures comprehensive emission reporting. Joint ventures complicate boundary setting due to shared ownership. Understanding these structures is essential for accurate GHG accounting and reporting. Different joint venture structures lead to varying reported emissions under each consolidation approach. This highlights the complexity of joint venture accounting. Establishing a base year is crucial for tracking emission performance over time. The recalculation policy ensures consistency and accuracy in reporting changes. Choosing a base year and understanding recalculation triggers are vital for accurate GHG reporting. This framework helps manage changes in emission sources effectively. Reporting boundaries must include all material emission sources. Excluded emissions should be disclosed to ensure transparency and accuracy in GHG reporting. A practical example shows how Shell's consolidation approach affects reported emissions. This illustrates the real-world impact of boundary-setting decisions. CDG training emphasizes the importance of organizational boundary setting in GHG accounting. It advocates for systematic assessment and transparent disclosure to prevent manipulation. Boundary setting is an ongoing professional responsibility. It requires active management, clear documentation, and consistent application to ensure accurate GHG reporting. Scope 1 emissions are the direct greenhouse gas emissions from sources owned or controlled by an organization. This chapter explores the measurement, calculation, and reporting of these emissions, which are crucial for effective management and compliance. Stationary combustion is the largest source of Scope 1 emissions for most organizations. It involves the burning of fuels in stationary sources like boilers and power plants. Understanding fuel consumption data sources and emission factor structures is key to accurate reporting. The emission factors for stationary combustion vary based on fuel type and combustion technology. This slide illustrates the UK DEFRA 2023 conversion factors, highlighting the importance of selecting the right tier for accurate emissions reporting. Mobile combustion involves emissions from vehicles and other mobile equipment. The fleet emissions and the Grey Fleet Challenge require careful consideration of fuel-based and distance-based methods for accurate measurement. This slide details the emission factors and calculation methods for mobile combustion, comparing fuel-based and distance-based approaches. It emphasizes the importance of accurate data collection for effective emissions management. Process emissions are highly variable and industry-specific. This slide explores emissions from cement, steel, and chemical industries, highlighting the need for sector-specific knowledge and methodologies for accurate reporting. The slide provides an analysis of major industrial process emissions, emphasizing the global significance and intensity of emissions from sectors like cement and steel production. Fugitive emissions are the unintentional releases of greenhouse gases. This slide discusses the challenges in measuring these emissions and the importance of accurate calculation approaches for refrigerant fugitive emissions. Refrigerants with high global warming potential pose significant challenges. This slide explains the mass balance calculation for refrigerants and highlights the importance of managing these emissions effectively. Building reliable inventories requires high-quality data. This slide outlines the rating system for data quality management, emphasizing the importance of accurate and comprehensive data for effective emissions reporting. Assessing and improving activity data quality is crucial for accurate emissions reporting. This slide presents the assessment framework and quality assurance checks necessary for maintaining high data standards. Biogenic carbon dioxide emissions are a complex aspect of Scope 1 accounting. This slide discusses the GHG Protocol Convention and the conditions under which carbon neutrality assumptions are valid. This case study of Heidelberg Materials illustrates practical Scope 1 accounting in the cement sector, showcasing the reporting framework and decarbonization levers used to achieve emissions reduction. CDG training emphasizes the importance of accurate fugitive emissions reporting and the professional standards required for effective Scope 1 inventory management. This perspective highlights the critical role of precise data in emissions management. The key takeaway is the importance of accounting for all Scope 1 emissions comprehensively. This involves understanding stationary and mobile combustion, process emissions, and fugitive emissions, ensuring transparency and accuracy in reporting. Of all the methodological innovations in corporate GHG accounting, none has generated more professional debate, more commercial consequence, or more genuine methodological complexity than market-based accounting for Scope 2 emissions. This chapter develops comprehensive knowledge of Scope 2 emissions, their calculation under both required approaches, the instruments used in market-based accounting, and the rapidly evolving landscape of electricity market instruments. The physical infrastructure of modern electricity grids creates the fundamental challenge of Scope 2 accounting. An organization consuming electricity from the grid is consuming a real-time mixture of all generation sources currently operating, and that mixture changes continuously as dispatch responds to demand fluctuations, renewable availability, and market prices. Grid carbon intensity varies significantly, both hourly and seasonally. This slide illustrates how grid carbon intensity metrics are demonstrated by hourly variation in seasonal patterns, emphasizing the complexity of calculating accurate emissions. The location-based approach calculates emissions using average emission factors for the regional or national electricity grid where energy is consumed, providing the most straightforward, most widely available, and most comparable measure of the impact of an organization's electricity consumption. The quality and granularity of location-based emission factor data varies substantially between markets. Professional practice requires using the most granular, most current, and most geographically appropriate factor available for each location. The market-based approach uses the emission factor from the specific contractual instruments through which an organization procures its electricity rather than the grid average, introduced in the GHG Protocol's 2015 Scope 2 guidance to recognize that the growing corporate renewable energy procurement market had created a commercially important class of electricity transactions whose carbon impact differs from that of grid average emission factors. The GHG Protocol defines a hierarchy of market instruments for market-based Scope 2 accounting. Not all instruments are methodologically equivalent. Some are preferred over others based on their quality and the degree to which they represent renewable energy consumption. The residual mix emission factor, a theoretical construct representing the carbon intensity of electricity that all certified renewable generation has been claimed by other instruments, is a technically critical component in market-based Scope 2 accounting, but one of the least understood elements of the European electricity disclosure system. The residual mix emission factor is conceptually paradoxical but plays a critical role in corporate reporting structure. This comparison reveals the relationship between national residual mixes and grid averages across Europe. The 24/7 Carbon-Free Energy (CFE) framework, powered by Google's commitment to match electricity consumption with carbon-free energy every hour of every day, represents the most significant methodological innovation in Scope 2 accounting since the introduction of the market-based method. Professional standard Scope 2 disclosure requires both location-based and market-based figures, transparent description of instrument types, and honest identification of gaps. This slide outlines best practice for Scope 2 disclosure for a multinational manufacturing company. The Scope 2 category encompasses not only purchased electricity but also purchased steam, heat, and cooling, energy commodities produced by external providers and consumed by the reporting organization's equipment at the reporting organization's facilities. Apple's transition from a company dependent on grid electricity to one powered by 100% renewable electricity for its operations is an instructive example of how organizations can achieve significant reductions in their Scope 2 emissions. Scope 2 accounting generates more professional confusion and more commercial controversy than any other component of the GHG inventory, and the source of that confusion is the widespread and profound misunderstanding of the nature and purpose of market-based Scope 2 accounting. Scope 2 accounting is not simply about assigning an emission factor to electricity consumption. It is a methodological framework for representing the complex relationship between energy procurement and carbon responsibility. The professionals who understand both its genuine insights and its genuine limitations are in the best position to explain the impact to the stakeholders who increasingly demand it. Scope 3 emissions are the carbon you own, embedded in everything your organization purchases, uses, and leaves behind. This chapter explores the comprehensive expertise required to produce credible value chain inventories. The case for Scope 3 is driven by financial, regulatory, and environmental imperatives. Financial sectors see it as crucial for global industrial and institutional investment, while regulatory pressures demand transparency in climate impact reporting. Scope 3 emissions dominate across sectors, representing the largest share of total value chain emissions. This insight highlights the need for organizations to address these emissions to truly manage their climate impact. The GHG Protocol defines 15 categories of Scope 3 emissions, covering both upstream and downstream activities. Understanding these categories is essential for accurate emissions accounting. A detailed reference of all 15 Scope 3 categories provides definitions, applicability, and calculation approaches, ensuring comprehensive understanding and accurate reporting. Scope 3 emissions require a hierarchy of methodological approaches, from spend-based to supplier-specific data, to ensure accuracy and balance between cost and implementation. Different calculation methods offer varying levels of accuracy and cost. Understanding these trade-offs is crucial for selecting the right approach for your organization. Category 15, Financed Emissions, is the most complex and material for the financial sector. The PCAF methodology provides a framework for attributing these emissions accurately. The PCAF methodology involves identifying exposure, determining EWC, calculating factors, and applying them to emissions, ensuring precise attribution for financial institutions. Developing a Scope 3 inventory requires strategic screening processes to prioritize efforts and ensure efficient data collection, focusing on material contributions to emissions. A roadmap for Scope 3 inventory development outlines a progressive approach from screening to best practices, ensuring continuous improvement and accuracy over time. Supplier engagement is key to transforming Scope 3 accounting into a meaningful exercise, enhancing supply chain relationships and driving real value chain emissions reductions. Unilever's approach to Scope 3 emissions exemplifies best practices in value chain carbon management, integrating agricultural supply chain strategies and professional transparency standards. CDG training emphasizes the importance of understanding Scope 3 emissions deeply, highlighting common missteps and the need for genuine engagement in corporate GHG accounting. Scope 3 is where the true climate impact resides. Measuring, communicating, and driving transformation in these emissions are essential for meaningful climate action. Understanding the numbers behind greenhouse gas inventories involves analyzing activity data, emission factors, and professional judgment. Each component plays a crucial role in ensuring the credibility of the results. Emission factor databases are essential tools for professionals, offering a wide range of data from national and international sources. These databases help ensure accuracy and consistency in GHG reporting. Guidance on major GHG emission factor databases highlights their coverage, quality, and application. Selecting the right database is crucial for accurate GHG inventories. Activity data collection is vital for GHG inventories, addressing challenges like data diversity and ensuring quality through systematic aggregation and validation. GHG inventory activity data involves various sources and integration systems, each with unique challenges and uncertainties that impact overall accuracy. Calculation methodologies involve tier selection and application, ensuring accuracy by matching calculation precision to emission source significance. GHG calculation methodology tiers are crucial for source categories, accuracy, and selection criteria, helping reduce uncertainty and improve precision. Uncertainty assessment in GHG inventories quantifies unknowns, emphasizing the importance of transparency and professional judgment in reporting. GHG inventory uncertainty assessment focuses on source attribution and total inventory uncertainty, highlighting areas for priority action to reduce errors. Professional judgment in emission factor selection is critical, considering factors like hierarchy, vintages, and documentation to ensure accurate GHG reporting. Walmart's Project Gigaton exemplifies practical application of GHG inventory principles, aiming for significant emission reductions through strategic data management. CDG training emphasizes the importance of professional judgment in emission factor selection, addressing challenges like factor lag and refrigerant problems. The key takeaway is that numbers must match reality, focusing on precision, rigor, improvement, and transparency in GHG accounting practices. The transformation of raw operational data into a credible, comprehensive, and professionally defensible corporate GHG inventory is the central operational challenge of corporate GHG accounting practice. This chapter covers inventory design, annual preparation, reporting formats, and more, emphasizing the importance of a methodical approach to GHG accounting. Establishing the scope, methodology, data architecture, and governance structure of a corporate GHG inventory is crucial. Different purposes require methodological compromises that must be managed within the inventory design. A corporate GHG inventory is established through a structured framework, including governance, data collection, calculation, and reporting. This framework ensures accuracy and reliability in GHG accounting. The preparation of a corporate GHG inventory follows a structured annual cycle, focusing on boundary review, data collection, validation, calculation, and review. This cycle ensures efficiency and quality in the GHG accounting process. The 12-month calendar for GHG inventory preparation is a year-round management process, with critical milestones and risks identified to ensure timely and accurate reporting. Quality assurance in GHG inventories involves systematic processes for detecting and correcting errors, ensuring data accuracy and consistency. This is crucial for maintaining the integrity of GHG reporting. Organizations with mature QA frameworks can significantly reduce verification time by implementing effective controls and procedures, ensuring reliable GHG inventory reporting. GHG inventories must be communicated effectively to different audiences, using various frameworks like CDP, TCFD, and CSRD to meet diverse regulatory and strategic requirements. Increasing convergence between frameworks like CSRD, ISSB, and CDP is observed, with organizations building comprehensive GHG inventories to meet evolving disclosure requirements. Various software tools, from spreadsheets to enterprise sustainability systems, are used to manage GHG inventories, affecting both the operational efficiency and quality of reporting. Transparent and narrative context in GHG reporting is essential, explaining methodology, year-over-year changes, and limitations to provide a credible communication of emission data. Current best practices in GHG disclosure involve a scoring framework that assesses completeness, methodology, year-over-year change, verification, and target performance, guiding organizations towards improved reporting. Tesco's journey in GHG inventory management illustrates the evolution from initial disclosure to comprehensive reporting, highlighting the importance of transparency and strategic alignment in corporate sustainability. CDG training emphasizes the practical challenges in GHG inventory management, advocating for investment in robust systems and processes to ensure accurate and credible reporting. A corporate GHG inventory is a managed information system, not just an annual document. It requires governance structures, quality controls, data systems, and transparent documentation to ensure accountability and reliability. The credibility of a GHG inventory cannot rest solely on an organization's own assertions. Independent verification by a competent third party is essential to establish the credibility that markets, regulators, and stakeholders require. Independent GHG verification is crucial for credibility, accuracy, consistency, and accountability. It ensures that GHG self-assessments are reliable, accurate, and prepared using consistent methodologies, providing a formal accountability mechanism. The GHG verification market is growing, driven by regulatory requirements and the need for error detection. Adoption rates and market value are increasing, with various providers offering verification services to meet these demands. ISO 14064 specifies principles for the verification of GHG assertions, focusing on independence, competence, ethics, and fair presentation. These principles ensure that verification is conducted with integrity and accuracy. The ISO 14064-3 process framework involves pre-engagement, planning, evidence collection, and evaluation phases. Each phase ensures that verification is thorough, addressing independence, competence, and fairness. Understanding the difference between limited and reasonable assurance is crucial. Limited assurance provides moderate confidence, while reasonable assurance offers a higher level of confidence, requiring more extensive procedures. Limited and reasonable assurance differ in procedures, evidence, and opinions. Reasonable assurance involves more rigorous procedures and provides a higher level of confidence, reflecting the industry's need for thorough verification. Materiality determines the threshold for acceptable misstatements in GHG statements. Quantitative and qualitative materiality help assess the impact of errors, ensuring that verification is meaningful and reliable. Verification findings are classified into material misstatements, non-material misstatements, disclosure deficiencies, and non-conformance. Each type requires a specific professional response to ensure accurate GHG reporting. Verifying Scope 3 emissions presents challenges due to their complexity. Emerging practices focus on data consistency, emission factor credibility, completeness, and disclosure quality to ensure accurate verification. KPMG's verification of BP's GHG inventory demonstrates a comprehensive approach to GHG verification, focusing on scope, criteria, and key activities. This example highlights the importance of thorough verification practices. GHG verification is often misunderstood. CDG training emphasizes the importance of understanding material misstatements and the value of verification in providing credible assurance, enhancing the quality of GHG inventories. Independent GHG verification builds trust by closing the credibility gap between self-assessed corporate claims and rigorous, independent evidence. It is essential for preparers, verifiers, and the system to ensure accountability and credibility. From measuring emissions to committing to reduce them, this chapter delves into the comprehensive knowledge of science-based targets and net zero frameworks. It emphasizes the importance of rigorous and independently verified GHG inventories as a starting point for corporate climate action. The translation of global carbon budgets into corporate-specific emission reduction strategies is crucial. This involves understanding the global constraints and exploring three allocation approaches: absolute contraction, economic intensity contraction, and sector-specific approaches. The SBTI target-setting methodology offers options and requirements for different sectors. It includes approaches like absolute contraction, sector decarbonization, cross-sector economic intensity, and financial sector targets, each with its unique advantages and applicability. The SBTI Corporate Net Zero Standard represents a significant advancement in emission reduction targets. It addresses core problems and outlines what the standard requires, including a 90% reduction in value chain emissions and beyond value chain mitigation. The pathway from base year through 2050 to net zero involves specific requirements for near-term and long-term goals. It highlights key distinctions and the importance of high-quality carbon removals in achieving these targets. Sector-specific pathways are essential for achieving the necessary emission reductions. Each sector, from power to financial institutions, has unique requirements and strategies to align with decarbonization targets. The required emission intensity reduction from 2020 to 2050 varies across sectors. This slide illustrates the different decarbonization trajectories needed for sectors like power and cement, emphasizing the importance of tailored approaches. Navigating the terminology landscape of net zero involves understanding the differences between carbon neutral and net zero, as well as the IPCC's definition of net zero CO2. This clarity is crucial for accurate corporate claims and strategies. The quality assessment of corporate net zero and carbon neutral claims ranges from carbon offsetting to high credibility practices. Recognizing common red flags and understanding the credibility spectrum is vital for genuine climate action. The target setting process involves moving from inventory to validated targets. It includes base year requirements, internal approval, target design, and submission, ensuring a comprehensive and strategic approach to emission reduction. Microsoft's commitment to becoming carbon negative by 2030 exemplifies strategic ambition and technical design. It highlights the importance of carbon removal portfolios and transparency standards in achieving ambitious climate goals. CDG training emphasizes the importance of science-based targets and the management commitment required to achieve them. It highlights the structural problem and professional contribution needed for successful implementation. The most important test of corporate climate ambition involves measuring, committing, reducing, and managing emissions. Organizations must treat science-based targets as operational commitments, requiring disciplined management to succeed. Chapter 12 delves into carbon markets, focusing on offsets, credits, and voluntary carbon standards. It examines the mechanisms and standards that determine the effectiveness of carbon pricing in driving climate benefits or financial gains. The concept of pricing carbon is a powerful tool in economic decision-making, influencing emissions, allowances, and credits. It involves various participants, market scales, and professional challenges, highlighting the essential role of GHG accountants. Compliance carbon markets, like cap and trade systems, set emission limits and allow trading of allowances. These systems are crucial for cost-effective emission reduction, with examples from the EU, UK, and California. A comparison of global compliance carbon markets reveals differences in coverage and pricing. The EU leads in coverage, while the IEA highlights gaps in alignment with climate goals. Voluntary carbon markets have evolved to offer a flexible approach to carbon accounting. They involve diverse project activities, standard bodies, validators, and market participants, enhancing emission reduction efforts. The voluntary carbon market is categorized by credit types, with significant statistics for 2023. It shows a growing market with billions in value and millions of credits issued, emphasizing the importance of credit quality. Carbon credit quality is determined by additionality, permanence, and integrity. These factors ensure that credits represent genuine emission reductions, with a focus on removal-focused projects. The ICVMC's core carbon principles provide a framework for assessing credit quality, focusing on governance, transparency, and robust quantification. This ensures high standards in voluntary carbon markets. The VCMI Claims Code of Practice guides corporate use of carbon credits, emphasizing that credits should supplement, not replace, emission reduction efforts. It categorizes claims into bronze, silver, and gold. A structured decision framework helps organizations define their carbon credit strategy, focusing on purpose, quality, priority, and portfolio construction. This ensures alignment with climate goals. The GHG Protocol Standard outlines how carbon credits should be accounted for in inventories, emphasizing transparency and disclosure. This helps prevent greenwashing and ensures credible climate strategies. The Gold Standard Foundation's projects, like clean cooking, demonstrate practical applications of carbon credits. These projects offer co-benefits in health, economy, and biodiversity, showcasing successful emission reduction. Carbon markets are at the intersection of finance and climate, requiring integrity and transparency. CDG training emphasizes the need for rigorous quality assessment to ensure credible and motivated climate action. The transition to mandatory greenhouse gas reporting marks a significant shift in corporate climate disclosure. This chapter explores the comprehensive frameworks of CSRD, SEC, TCFD, and ISSB IFRS-2, which are reshaping the methodologies for reporting emissions in the modern business landscape. The Corporate Sustainability Reporting Directive, or CSRD, is Europe's comprehensive framework for climate change reporting. It introduces a phased approach, starting with large EU companies in 2024, and expanding to smaller entities by 2028, ensuring a structured transition to mandatory reporting. The CSRD ESRS-E1 matrix outlines the disclosure requirements for climate change, focusing on governance, strategy, and risk management. It emphasizes the need for detailed GHG disclosures, including transition plans and carbon removals, to meet the new standards. The SEC Climate Disclosure Rules, effective from March 2024, mandate U.S. companies to disclose climate-related risks and GHG emissions. The rules exclude Scope 3 emissions for most companies, focusing on material climate risks and financial impacts. The SEC climate rules outline the requirements and timeline for U.S. companies, emphasizing physical and transition risk disclosures. The rules are currently challenged in court, but companies are advised to prepare for compliance. The TCFD framework, established by the Financial Stability Board, integrates climate risk into financial reporting. It focuses on governance, strategy, risk management, and metrics, providing a comprehensive approach to climate disclosure. The TCFD framework's 4 pillars, governance, strategy, risk management, and metrics, guide companies in integrating GHG accounting into their financial strategies, ensuring a holistic approach to climate-related disclosures. The ISSB-IFRS S2 framework integrates climate disclosure with financial reporting, offering a global pathway for adoption. It emphasizes the importance of aligning climate-related disclosures with financial standards for comprehensive reporting. The Global Mandatory GHG Reporting Map highlights the convergence and divergence of various frameworks. It shows the widespread adoption of mandatory reporting, covering over 250,000 companies by 2030, with significant market cap and emissions coverage. The UK has developed a layered approach to GHG reporting, combining SECR and SDS frameworks. This approach ensures comprehensive climate disclosure, with a focus on energy consumption and emissions intensity. Unilever's compliance with multiple frameworks showcases a practical example of integrating various GHG reporting standards. Their approach highlights the efficiency of using a single inventory foundation and TCFD-aligned reporting for comprehensive disclosure. CDG training emphasizes the opportunity and responsibility in the evolving GHG reporting landscape. They highlight the importance of meeting regulatory demands and the potential for professionals to lead in this transformative era. The key takeaway is the shift from voluntary to obligatory GHG reporting, driven by regulatory, methodological, and assurance demands. This transition presents commercial opportunities for those who master the new standards. Chapter 14 delves into sector-specific GHG accounting, focusing on energy, industry, transport, and buildings. It emphasizes the importance of technical depth in understanding emissions across these sectors, which are responsible for 85% of global greenhouse gas emissions. The energy sector is complex due to its diverse infrastructure and significant emissions. Key challenges include managing emissions from power generation and fossil fuel operations, which account for 34% of global emissions. Energy sector GHG accounting involves understanding emission sources and methodological challenges. Different sub-sectors like oil, gas, and power generation have unique calculation approaches. Heavy industry, including steel, cement, and chemicals, presents significant challenges for GHG accounting due to its high emissions intensity and complexity in process emissions. Sector-specific methodologies for heavy industry involve detailed calculations for emissions from steel, cement, and aluminum production, each with unique challenges and factors. The transport sector, responsible for 14% of emissions, faces unique challenges in aviation, shipping, and road transport, each requiring specific strategies for reduction. Transport GHG emission factors vary across modes like aviation, maritime, and rail, highlighting the need for tailored strategies to reduce emissions effectively. The building sector accounts for 40% of energy consumption and 30% of energy-related emissions, with operational and embodied carbon being key focus areas. Building sector GHG accounting covers the entire lifecycle from construction to demolition, emphasizing carbon savings beyond system boundaries. The financial sector's GHG accounting is complex due to financed emissions and portfolio carbon, requiring unique methodologies like PCAF for accurate measurement. Financial sector GHG accounting involves metrics like absolute emissions and portfolio temperature scores, crucial for understanding climate impact. Shell's sector-specific reporting highlights the complexity of GHG disclosure in the oil and gas sector, focusing on intensity-based targets for emissions reduction. CDG training emphasizes the value of sector expertise in GHG accounting, showcasing how deep knowledge in specific sectors leads to more effective emissions management. The key takeaway is the integration of general competency, sector expertise, and strategic advisory to provide differentiated services in GHG accounting. You've completed a comprehensive certification program in greenhouse gas accounting, preparing you for professional impact. The GHG accounting market faces extraordinary demand with limited supply, driven by regulatory requirements and corporate commitments. Explore career opportunities in GHG accounting from 2024 to 2030, with insights into salary benchmarks and employer distribution. Discover diverse career pathways in GHG accounting, from corporate sustainability to policy and public sector roles. Understand the professional career trajectory for certified GHG accounting specialists, from foundation to leadership stages. Build your credential portfolio with professional certifications in GHG accounting, enhancing your career prospects. Explore the requirements and market value of professional certification portfolios in GHG accounting. Apply your knowledge through immediate professional actions, enhancing your career over time. Engage in high-impact activities for career development, balancing time investment with career impact. Stay current with ongoing professional development in GHG accounting, adapting to new methodologies and regulations. Explore emerging frontiers in GHG accounting, including AI integration and digitalization of carbon markets. Discover emerging professional opportunities in GHG accounting from 2024 to 2035, driven by technological and regulatory changes. Begin your professional journey with certification in GHG accounting, available fully online and self-paced. Experience a complete online learning journey, designed for working professionals in GHG accounting. See a practical example of career transformation through GHG accounting expertise, illustrating immediate and long-term impacts. CDG training emphasizes the immediacy and deliberateness of applying knowledge in GHG accounting. Enroll in CDG training to get certified, accelerate your career, and make an impact in GHG accounting. Thank you for choosing CDG training, your partner in GHG accounting excellence and professional leadership.